The Panic of 1907. How a banking crisis led to the creation of the Federal Reserve. The early 20th century in the United States was a period marked by significant transformation characterized by rapid industrial growth, increasing urbanization, and the emergence of a more complex financial system. As the turn of the century, the United States was experiencing a shift in its political landscape, moving from a more agrarian society towards an industrial powerhouse. The Progressive Era was gaining momentum, focusing on reforming the government and addressing social issues such as labor rights, women's suffrage, and corporate monopolies. President Theodore Roosevelt was in office, advocating for trust-busting and regulatory measures aimed at curbing the excesses of big business. This era also saw tensions related to labor strikes and the rise of labor unions as workers demanded better wages and working conditions. Economically, the country was transforming from a predominantly agrarian economy to an industrialized one. The United States was becoming a major player in global trade, fueled by technological advancements like the telegraph and railroad systems, which improved communication and transportation. The economy, however, was not without its challenges. The financial system was still largely unregulated, leading to speculative investments and frequent bank failures. Economic growth was often accompanied by instability, as evidenced by earlier financial panics in 1873 and 1893. Socially, the early 1900s were defined by stark contrast between wealth and poverty. While industrialists amassed fortunes, many workers faced grueling labor conditions for meager wages. Immigrant populations flocked to urban centers, contributing to a diverse cultural landscape but also facing discrimination and challenges in assimilation. Daily life for the common person often revolved around long work hours at factories with little regard for safety or health. Labor strikes were common as workers organized for better conditions, often clashing with law enforcement and industrialists. Culturally, this period was vibrant, with movements in literature, art, and music reflecting the complexities of modern life. The rise of mass media, including newspapers and magazines, influenced public opinion and fostered a sense of shared national identity. Technologically, innovations such as the telephone and electricity were transforming daily life, making urban living more manageable and connected. Overall, the early 1900s were a mix of prosperity and turmoil. The optimism of the industrial age was palpable, yet it was tempered by the realities of economic inequality and the struggles of the working class. The nation was on the cusp of significant change, and the events leading to the Panic of 1907 would further highlight the vulnerabilities of an evolving financial system. As financial instability loomed, the public grew increasingly anxious, setting the stage for one of the most consequential financial crises in American history. The crisis began in the fall of 1907, triggered by a failed attempt to corner the market on United Copper Company stocks. The investment scheme, led by the speculator F. Augustus Hines, unraveled when it became apparent that the company's financial standing was shaky. As news of the failure spread, depositors rushed to withdraw their savings from banks with ties to the scheme, leading to a domino effect of bank runs across the country. Within weeks, several banks collapsed, including the Knickerbocker Trust Company in New York, which was one of the largest trust companies at the time. As people lost confidence in the banking system, panic spread, and more banks found themselves unable to meet withdrawal demands. By late October, the stock market had plummeted, losing nearly 50% of its value in a matter of weeks. The Panic of 1907 illustrated the inadequacies of the banking system, particularly the lack of central banking. Banks operated independently and did not have sufficient reserves to handle sudden withdrawals. To address the crisis, a coalition of bankers and financial leaders, including J.P. Morgan, came together to stabilize the financial system. Morgan, leveraging his influence, orchestrated a rescue operation to shore up failing banks. He gathered a group of bankers to provide liquidity to the market, pledging their personal wealth to stabilize the situation. One significant action taken was the rescue of the Trust Company of America and the New York City banks that were under threat. By forming a syndicate, the bankers managed to inject capital into the system, which helped restore some level of confidence. Morgan's leadership and reputation played a critical role in averting a complete financial collapse. The motivations behind the financial actions during the Panic of 1907 were primarily rooted in self-preservation and maintaining confidence in the financial system. As the banking crisis unfolded, the immediate need was to prevent a total collapse, which would have far-reaching consequences not only for the banks involved, but also for the broader economy. There were significant economic incentives at play as well. The U.S. was in a period of rapid industrial growth, and a financial collapse could have stifled that growth. Furthermore, banks had become increasingly intertwined with industry, and a banking failure would have devastating implications for the businesses relying on credit. The urgent need for a more stable financial structure became clear as the crisis unfolded. Public reaction to the panic of 1907 was one of fear and distrust. Many depositors lost faith in the banking system, leading to a shift in public perception regarding the need for reform. The government's inability to effectively manage the crisis highlighted the need for regulatory measures, leading to calls for a more structured financial system. In the aftermath, the government began to explore the idea of a central banking system to prevent future crises. The panic underscored the necessity for a central institution capable of managing liquidity and providing stability during times of economic distress. This crisis set the stage for the eventual establishment of the Federal Reserve System in 1913, aimed at creating a safer and more flexible monetary system in the United States. The Panic of 1907 served as a wake-up call for the U.S.'s financial system, emphasizing the importance of a centralized authority to manage monetary policy and stabilize the economy during tumultuous periods. Key figures of the Panic of 1907 were J.P. Morgan and Charles E. Mitchell. J.P. Morgan was born on April 17, 1837, in Hartford, Connecticut, to a prominent banking family. He was educated in Europe and later returned to the United States to work in his father's banking business. By the late 19th century, Morgan had established himself as one of the most powerful bankers and financiers in America. He was known for his commanding presence, strong leadership, and exceptional negotiation skills, often described as a man of immense intellect and vision. Morgan was a pragmatist who believed in the importance of financial stability and was willing to take bold actions to maintain it. Morgan's involvement in the Panic of 1907 was driven by a blend of necessity and a sense of responsibility. As a leading financier, he understood that the banking crisis threatened not only his interest, but the entire financial system. The collapse of banks would have had dire consequences for businesses and the economy at large. During the panic, Morgan took on a leadership role by rallying other bankers to stabilize the financial system. He organized a coalition of financial leaders to provide liquidity to the failing banks, including the Trust Company of America. Morgan personally infused his own wealth into the rescue efforts, signaling to the public and other investors that he believed in the stability of the financial system. His decisive actions and ability to negotiate effectively helped restore some confidence during a period of widespread fear. Charles E. Mitchell, born in 1861 in Pennsylvania, became a prominent banker and financier. He rose through the ranks to become the president of National City Bank, one of the largest banks in the United States at the time. Mitchell was known for his keen business acumen and aggressive investment strategies. He was a forward-thinking banker who was willing to embrace new financial products and practices, often pushing the boundaries of conventional banking. Mitchell's involvement in the Panic of 1907 stemmed from his ambition to solidify National City Bank's status as a leader in the financial sector. As the panic unfolded, Mitchell recognized the critical need for collaboration among banks to stabilize the situation. He worked closely with J.P. Morgan and other leading bankers to formulate strategies to address the liquidity crisis. During the crisis, Mitchell took swift action to support fellow banks facing runs. He leveraged National City Bank's resources to provide loans to struggling institutions and helped to restore confidence among depositors and investors. His proactive approach and willingness to collaborate with other financial leaders were crucial in mitigating the immediate impacts of the crisis. Both J.P. Morgan and Charles E. Mitchell played pivotal roles in navigating the Panic of 1907. Morgan's status as a prominent figure in the banking community allowed him to lead the charge in organizing a response to the crisis, while Mitchell's aggressive banking strategies and supportive collaboration among financial institutions helped to address the liquidity issues plaguing many banks. Their combined efforts not only provided immediate relief during the panic, but also highlighted the need for a more structured banking system, leading to discussions about the establishment of the Federal Reserve. The actions of these two influential figures underscored the importance of strong leadership in times of financial distress and set the groundwork for future reforms in the American banking system. One of the most significant lessons from the Panic of 1907 was the importance of having a centralized banking authority capable of managing financial crisis. The panic underscored the interconnectedness of financial institutions and the broader economy, illustrating how the failure of one bank could have ripple effects throughout the entire system. The event also reinforced the necessity of transparency in banking operations and the need for banks to operate with a clear understanding of their risk exposure. The establishment of the Federal Reserve was a response to these insights as it aimed to foster stability and confidence in the financial system. Moreover, the Panic of 1907 shaped public perceptions of banking institutions and highlighted the demand for accountability and regulation. It led to a more active role for the federal government in the economy, setting the stage for future reforms during the Great Depression and beyond. Overall, the Panic of 1907 was a crucial turning point in American financial history. Its immediate impacts were marked by economic turmoil and public fear, while its long-term legacy paved the way for significant changes in banking practices and regulations. The creation of the Federal Reserve and the emphasis on financial stability and oversight can be traced directly to the lessons learned during this tumultuous period, making it an enduring lesson in the importance of effective financial governance.